Most traders focus on indicators, charts, patterns, never grasping what actually moves the markets. Liquidity. If you ever been stopped out and then price goes your way, or you enter the trade thinking price is gonna be ready to break out and then V-shapes the opposite way, well, you just experienced liquidity. Today I'm breaking down what is liquidity, why it matters, and most importantly, how it can help you in your trading. These are the exact concepts I use every day to find high probability setups and avoid common traps in the markets. Let's dive in. Liquidity in the simplest forms is just orders in the markets. Buy orders, sell orders, stop orders, take profit orders, just money exchanging through the markets. The markets requires liquidity for it to move, or it just be flat and not move the whole time around. When orders are filled is when market tends to pick directions. You need to find where those orders are and how you can be in the right direction of the move. Think of liquidity as the fuel that is moving the markets. High liquidity assets like the Nasdaq and S&P 500 have smooth price action, while low liquidity assets are choppy and harder to trade. Understanding where liquidity exists will give you a grasp of understanding where price is most likely to go. And this is why certain price levels act as magnets for price to always retrace to. To understand liquidity, we have to understand who is creating this liquidity. Number one is institutional trading, which means banks, hedge funds, any high volume trader. And number two, us, retail traders. We provide much smaller liquidity to the markets, but we do play a role. We're the small fishes trying to follow the big sharks through the waves. The main difference between retail traders is that typically we take smaller position sizes. Typically, we're putting our stop losses in very obvious spots where it makes it easy for large institutions to hunt them out and take price the opposite direction. Remember, if you don't know where the liquidity is, it means you are the liquidity. While institutional traders are trading usually with much larger position size, can't just exit and enter the trades right away because they have these huge positions. They need to wait for liquidity to be created to then fill their orders and take price in a certain direction. Now, between these two, it creates a natural conflict. Retail traders are trying to survive while institutional traders are seeking liquidity to hunt it out and be able to fill their orders to take price in the direction they like. This is mostly the dynamic that moves price every single day as you see it. If you start to understand the relationship that this has, the retail traders and institutional traders, it becomes much more easy to understand why price moves the way it does. Liquidity doesn't get formed at random levels. It is usually predictable. Think about supply and demand zone. Think about areas where price chopped around. You're like, hey, this demand zone is finally broken. Let me take a short position, and then boom, we get a V shape right back up. What just happened? Well, during a period of consolidation, they built up liquidity. They waited for all these traders to take the positions. They then took them out by filling their orders, stopping them out, and taking that liquidity and took it the opposite direction. Now, there are other key levels to understand liquidity. Think about run numbers, 4,500, 5,000. Retail traders love to use those as simple stops. And guess what? There's nothing simple in the markets. If you think your stop is safe, it can always be hunted out, but there's institutional traders. Recent swing highs and lows. A lot of times, institutional traders love to take out the most recent swing high and lows to attract traders. Make them think, hey, this bullish trend has just ended. The recent low just got taken out. Let me get out of this trade. Or hey, maybe let me try a short position. And guess what? Big 1 minute candle, opposite direction, drops everybody and everyone gets taken out. Also, key simple indicators like the 50 moving average, 200 moving average, volume weighted average price, also known as the VWAP. They know retail traders and a lot of traders in the markets are using them as their stop loss. So they will quickly close price below it, let these people get stopped out and quickly close above it. This is why if we understand liquidity, like the way I'm explaining it, you need to learn how to master where to put your stop loss and avoid these traps and be part of the pool that's trapping all these retail traders. Another really important levels to mark out is daily, weekly opens. Also the previous day highs and lows and the pre-market highs and lows. Those are areas that the markets loves to take out and then V-shape right back up. Now when we get a V-shape like move is exactly what we call a liquidity sweep. Liquidity sweep is when a key high or low gets taken out and then quickly we take a V-shaped recovery back above it and drive price action the opposite direction. The anatomy of a liquidity sweep is very simple. Accumulation, which is a period where price goes sideways. Think about the chop. This is the period you want to avoid. Whenever we get caught up in this chop is when we make the most mistake. We need to stay patient. Then we get our sweep, which is also called our manipulation move. Price goes sideways, then it manipulates, which means it fakes out one direction. It makes traders think, oh, finally we're picking a direction, and then we get our sweep, which is our V-shape right back up that leads to our distribution phase, the actual direction where price meant to go the whole time. This is why oftentimes whenever you have a key level, you see price break it, manipulate under it, and then V-shape up. The key level is usually drawn out on thousands of charts around the world, and it has a ton of orders right under it. We want to fill those orders and then wait for the V-shape back up. Understanding this pattern gives you an enormous edge on the markets. It helps you avoid simple traps of where to put your stop losses in the wrong places. It helps you understand that you need to stay patient and wait for the direction to be shown to you before you try to predict it. It helps you stay away from those manipulation moves that can trap you. And also, it helps you follow the direction of where institutions want to take the trade. Now, if we know institutional traders, also known as smart monies, need liquidity to trade and fill their orders, how can we use it to our advantage? They can't simply just market order these $10 to $20 million orders. Why? It would give them horrible feels, it would trap them in bad trades, and it's just too much for the market to handle. Instead, they use sophisticated tactics that identify areas of liquidity concentration. They engineer moves to access this liquidity. They use the resulting order flow to execute their orders. And this creates predictable patterns. Liquidity sweeps before major moves, sharp moves through support and resistances, and quick reversals after stops are triggered. By understanding these patterns, you can start trading alongside the smart money versus getting trapped with the retail traders. Identifying these liquidity zones can be a skill that you can practice. One of my personal favorites is looking for equal highs and equal lows. A lot of beginner traders will look at this and see it as support and resistance area, while a lot of institutional money will see this as an opportunity to take out that equal high or equal low, because they know there will be stops placed under it, and breakout traders are going to try to trade alongside it. They can track both sides and drive price the opposite direction. One of my favorite things to do is watch for low volume during accumulation. You'll see price dropping volume this accumulation period. Then we see a sharp rising volume when we get the move to the downside, and quickly the next candle and move right back above. This shows that they waited for a bunch of stops to be hit to then fill their orders and drive price the other way. The most powerful ways to do this is to follow the 4-hour or more time frame trend. A lot of times we get a 4-hour time frame bullish trend, and then we look for 15-minute accumulation levels. As traders are looking for a reversal back down to look for a bearish trend to be built, we get accumulation and manipulation that shows a fake move to the downside and then quickly a move right back above. A lot of times people thinking that trading these AMDs or accumulation manipulation distributions are reversals, but realistically, more often than not, there are small time frame reversals that are still playing alongside the overall trend on the 4-hour and above. Lastly, pay attention to time-based entries. There is certain times that are more likely to present yourself with these setups. One of them being 10 a.m. EST, which is the main time frame that I'm usually trading, or 8:30 a.m. EST. A lot of times when it coincides with a red folder news, they will use the news to cause this big reaction to then drive price the opposite direction. If you want to see me trade these liquidity concepts in real time, I'd ask you to consider potentially joining my mentorship, where I trade live every single day with my mentorship students. I break down setups every single day and I show them exactly where these sweeps happen and how liquidity is created and formed. I show them the difference between taking proper setups and not fall for low quality or traps built by the markets. The link is in the description. Thanks for watching, and I'll see you in the next video.